My name is Jacob Hovat, and I am doing my individual presentation on the Walt Disney Company with the ticker DIS. This is for Econ 301, Professor Silverman. Today I will be going over a background of the company, the industry the company is in, the managers, the company classification, analysis of the CEO, analysis of the stock, analysis of financial statements, a look at the competitors' financials, and a recommendation to investors. The contents of the presentation include background of the company, classification of the company, market shares, analysis of the income statement and balance sheet, as well as analysis against competitors, analysis of stock, strengths, weaknesses, opportunities, threats, and a recommendation of the background of the company. The Walt Disney Company was founded by Walt Disney and brother Roy Disney and became a corporation on October 16, 1923. The very beginning, Walt focused on developing animated shorts like Steamboat Willie, which features the famous Mickey Mouse. This was Disney's first film and was a huge seller. This allowed Walt Disney to expand, move around studios in Hollywood, and earn money and popularity. Walt Disney started off in a small garage, but as he developed more popular cartoons and they sold, he made more money and expanded his business. His childhood interest in amusement parks led to the development of Disneyland, which opened July 17, 1955. And after this, Disney became the powerhouse that we know them today. Now, what does the Walt Disney Company do? Walt Disney Company is a global entertainment company that operates in various markets, including TV, cable, theme parks and amusement parks, resorts, consumer products, and movie and television production. The top three industries they operate in are cable networks, television broadcasting, movie and video production. Another industry they also operate in is their amusement park industry, in which they have the largest market share at 49.5%. Disney also produces the global box office hits. They attract tourists from around the world to its amusement parks. They produce sports and news media content like ESPN and Disney Plus, and produce television and streaming content like Disney XD, ABC. Moving on, we look at its managers. The key executives include the CEO, Robert or Bob Iger. He took over in 2005 after the former CEO, Michael Eisner, had stepped down. Senior Executive VP includes Alan Braverman. The Chief Financial Officer is Christine McCarthy. The Senior Vice President, James Kappenstein. The Vice President, Daniel Grossman. And notable people include Kathleen Kennedy, President of Lucasfilm, Star Wars, and Kevin Feige, President of Marvel Entertainment. What industry is the Walt Disney Company operating? They operate mainly in video production, cable, paid TV services, and other subscription programming industries. As I mentioned before, they also operate in the amusement parks industry. Their four business segments are 1. Media networks, 2. Parks and resorts, 3. Studio entertainment, and 4. Consumer products and interactive media. And their North American Industrial Classification Code is 515210, and their SIC 4841. Transitioning to a description of the industry. They work within the entertainment and digital services. They have competition between big players such as AT&T, Comcast, Viacom, Warner Media. Revenues within this industry are high and growing, indicating long-term growth. These players have already been established for a very long time, and their net income and revenues are very high, so they won't have a problem existing and progressing through these industries. And big players have plenty of room for expansions into new markets. Take, for example, the streaming wars going on. that Disney Plus is now going to be involved. Now looking at the classification of the Walt Disney Company. They have market shares in four main industries. That's cable networks at 18%, television broadcasting at 10.5%, movie and video production at 29.2%, and amusement parks are their largest market share at 49.6%. Walt Disney Company is a global conglomerate with operations in multiple industries and several countries, operating in the main four industries stated above. Now let's take a look at the analysis of the CEO, Bob Iger. Bob Iger took over the CEO position in 2005, and he made Disney the multi-international corporation that we know today. The reason why he took over, in 2005, with former CEO Michael Eisner, the stock had plummeted 1/3 because of his business dealings and job as CEO. Upon leaving, Iger stepped in. And since then, Disney has produced 9 #1 movies. The 8 Disney parks are the 8 out of 10 busiest amusement parks in the entire world. And Disney has acquired Pixar Studios, Marvel Studios, Lucasfilm, and 21st Century Fox, arguably some of the biggest names in movie and television production that there is. Now, what kind of managerial approach does Bob Iger take to his company? Well, he takes a hands-off managerial approach by creating promoted freedom so that there's not so much control from the top down. This allows artists to create art and not be subjugated to rules or restrictions that may repress their artistic freedom. I have a quote here from Investors Business Daily, in which Bob Iger says, quote, "Nothing is more important than the creators, the creative process, and the creative output. You're basically making bets on people and ideas versus anything else." This type of management style, non-controlling from the top down, allows creatives in all departments to take responsibility for their own actions, their own work, and produce their own individual content. Bob Iger also allows creatives to take risks, understanding that, quote, "near-term failures are part of the process of achieving long-term success." Iger's style of knowing that short-term projects, while they may fail, big budget long-term ones will always succeed. At the end of the day, he's focused on those large projects, about having creatives come together, put their minds and their efforts together, create big projects to produce big profits. However, Bob Iger is not focused necessarily on chasing profits. He's focused on the quality of the output of content. His recent statement to the New York Times on the streaming industry affirms this. Quote, "What Netflix is doing is making content to support a platform. We are making content to tell great stories. It's very different." Iger's hands-off, top-down approach and focus on creative content surely drives profits more than a company who would be in the opposite of focusing straight on profits and not caring about what their creatives have to create. Moving on, let's take a look at the company timeline of significant events. At the latter part of 2005, Bob Iger becomes CEO on 10/01/2005. After that, Disney purchases Pixar Animation Studios in mid-2006, and in mid-2007, the first Disney co-production in China premieres. This was a huge step into bursting into the Chinese market, as everyone nowadays would like to do. After this, early 2009, Disney XD launches on cable and replaces their previous Disney cable TV services. Shortly after this, Disney becomes an equity owner of Hulu. And after this, in 2010, Disney acquires Marvel Entertainment for $4.24 billion on 12/21/2009. After this, Marvel's Avengers premieres and becomes the 7th highest grossing film ever. This is on May 4th, 2012. In the same year after this, Disney agrees to purchase Lucasfilm. This was a contract worth about $4 billion, similar to that of Marvel Entertainment, slightly cheaper. After this, Frozen premieres and becomes the highest grossing animation film ever. This was in 2013. And a few years forward, Star Wars The Force Awakens premieres. Episode 7, it becomes the 4th highest growing film of all time. That was on December 18th, 2015. After this, many other small events, but significant ones happen. Academy Award-winning film Coco appears. ESPN streaming service ESPN Plus launches. After this, Avengers Infinity War appears and breaks many records at the box office. After this, Disney Plus's streaming service is revealed, and Disney acquires 21st Century Fox on March 20th, 2019. And to end this all out, Avengers Endgame premieres. Avengers Endgame will go on to become the highest grossing film of all time. Moving on, we have analysis of Disney stock. As we can see here, we have resistance and support bands, as well as Bollinger Bands to express the level of resistance and support and trend lines. Upon the early years of 2019, or the early days of 2019, going before into the latter days of 2018, we see the stock price relatively lower than what it is now, about $20 lower per share at about $110. We see the Disney stock hit support bands and resistance bands in a continuous trend for a few months, while around mid-April, when their Disney Plus streaming service was announced, there was a huge rise in the stock price. After that, we see a similar trend going on from May to now, of the stock fluctuating between resistance and support. Up until now, the stock price is at $130. There was a year high of $146.38. That was on 7/29/2019. And I'm predicting that because this resistance and support trend from May to now is similar to that of November to April's resistance support trend, I think the company's stock will likely rise over the year. There's a much anticipated streaming service of Disney Plus arriving, the holiday season coming around the corner, and surely plenty of films that will top the box office. As the company grows more, gains more profits, and produces more, the stock price will sure rise. Let's move on and take a look at Disney's financial statements, starting with the income statement. In the highlighted areas, I have the most important line items on the income statement. Here's the analysis. From right to left, we have the dates reporting 10/01/16, 9/30/2017, and 9/29/2018. This is consequently all the same dates for the following financial statements. Notable items. Net income for the Walt Disney Company is up 40.3% from compared to the previous year, 2017, of negative 4.4%. This is an insane amount of revenue attributable to the Walt Disney Company. From a low of negative 4.4% in 2017 to now 40.3% in 2018. It's quite the rise. Total revenue is up at $59.4 billion, about $4 billion up from 2017. And income taxes are down negative 62.4%. This is likely because of the change in tax code, and this can be partially attributable to the net income that Disney has. Their lower payment of taxes is attributable to a higher net income. Total costs and expenses represent 75% of total gross sales. And the service cost is the largest part of that at 46.3% here. Now let's look at net income represents 21.2% of all gross sales. 1.2% of all gross sales. Now let's look at the profitability ratios. The return on assets for the Walt Disney Company is 13%. So that means that for every dollar that Disney invests in assets, 0.13 cents is attributed to net income. This might not seem too high, but it could tell a different story of assets being distributed out over the long run, and that payment being distributed over a large series of time. Now, return on equity, which is essentially a return on total assets or net assets, is 28.05%. This is a high return on net assets for shareholders, indicating that Disney has much control over their assets. Let's move on to the balance sheet and looking primarily at its assets. I have the asset side of the balance sheet here, and in a few slides I will show you the liability side. Notable things here on the assets. Goodwill represents the highest portion of total assets at 31.7% here. This is an interesting number to look at as Disney acquires more and more companies. They give out more and more goodwill, which essentially shows to analysts and investors that the company has plenty of cash to pay over the book value of these companies to make up that amount. Total current assets account for 17.1% of all assets, telling that Disney takes into account long-term assets more than they do current assets. And all other line items on this financial statement have been consistent through the last 3 years. However, a notable change in cash and cash equivalents had decreased from 12.9% to 3.3% from 2017 to 2018, showing that possibly when Disney ramped up operations, they put more cash out there and used more of it. Now let's look at the ratio analysis. Let's look at the cash flow per share, which is 9.56. That is the net cash that Disney produces per share, meaning that investors have an average return of $9.56 after taxes and depreciation and amortization is accounted for. This is a net average return of 9.56 after all costs are accounted for per share for Disney. Let's move on to the liability side of the balance sheet. Treasury stock takes up the largest portion of liabilities at 49.4%, as we can see here. Total borrowings amounts to 28.3% of total liabilities plus stockholder equities. There's total borrowings, 28.3%, as a part of total equity and total borrowings. And overall liabilities this year are lower than in the years past, while assets have relatively stayed the same. Let's take a ratio analysis of 9:29:18. Here's a quick ratio of 0.75, which essentially tells that if the company were to liquidate, if they had enough money to pay off their short-term liabilities, this is a quick ratio of 0.75. Now, what this essentially shows is that Disney may not have enough money at hand to pay off all their current liabilities if for whatever reason they had to liquidate quickly. But like we said before in our analysis, Disney is focusing on long-term assets rather than short-term ones. So in the long run, they'll have plenty of time to gain enough money to pay off all debts. At a current ratio, this is what they owe in debts compared to what they have to pay with in assets. Current ratio of 0.94. Now, while a current ratio of 1 or greater would be better, meaning that they have more assets than they can pay with liabilities, once again, this is only current liabilities and current assets, not long-term assets and liabilities. Now let's take a look at the comparison of peers. The Walt Disney Company is up against AT&T, General Electric, Comcast, Viacom, and News Corp. Now their revenues fall directly in the middle of most of these companies, and they have a net income that is, while still high, smaller than the highest, AT&T. They have a significantly lower amount of total assets than AT&T, General Electric, and Comcast, as well as their liabilities. However, it seems here that Disney does have twice the amount of assets than they do liabilities in total. The price earnings ratio is 16.4886, which is a nice amount of return for investors. This is only second to Comcast Corporation. They have one of the highest market caps, just under AT&T within the industry, and they employ 201,000 people. Disney boasts a very impressive stock price of $130.26, far higher than all the others, showing that to investors, if they can invest in this stock, they would have a far greater rate of return than the other companies. And moving on to our SWOT analysis, our strengths, weaknesses, opportunities, and threats. Let's take a look at the strengths of the company. Strong management from the top down. Like I said before, Bob Iger does not take a micromanagerial approach. He allows creatives to create. He allows expressive freedom in his company. It allows each department to take their own responsibility. As we've seen through the financial statements and analysis, this has obviously done a very good job for Disney. And they are already positioned in growing markets, such as the Chinese market. They've been positioned in the Chinese market for a very long time and have 2 amusement parks in both Shanghai and Hong Kong. Moving on to weaknesses. Competition against new content providers can undercut price. Look, for example, when Disney Plus first released the name and pricing at $6.99 a month. Shortly after that, Apple TV came out with their own streaming service and undercut prices by $2 at $4.99 a month. Another weakness and regret that Bob Iger actually has is pushing content into the markets too quickly. Take a look at Star Wars. While many of the Star Wars projects have done a great deal in producing profits and expanding Disney's power in the industry, they've also pushed content into the market too quickly. Take a look at 2 of the Star Wars projects, Star Wars Rogue One and Star Wars Solo, both which underperformed at the box office, and while still made a profit, did not make good marginal returns as compared to the other Star Wars projects. And emerging into markets with already established players can always be a threat or a weakness, such as the streaming service wars going on. We already have established players like HBO, like Netflix, like Hulu, that Disney Plus now has to compete with, as well as a new entrance like Apple TV. Let's move on to the opportunities, which seem high. Providing content through streaming services is a huge opportunity. Like I said, Disney Plus has good content coming to it soon that many people will subscribe to. Disney already has a foot in esports, which is another huge growing industry around the world. They established the Overwatch League about a year ago on ESPN, ABC, and Disney XD. This plays alongside on Sundays before NFL Sunday starts. An acquisition of 21st Century Fox allows great opportunities and new stories to be told by Disney. They will surely take advantage of the already established storylines within the 21st Century Fox universe and will continue to grow on them. Now let's move to threats, our last part. While the acquisition of the 21st Century Fox company seems like a good idea, it could have a backfire. There is much antitrust and monopoly sentiment going on today in America, and Disney, with their consolidation of power, of monopoly power by acquiring these companies, seems to be part of that. If they were to hold up in a congressional hearing for antitrust activities, they surely would have some repercussions, especially to their financials. Disney's streaming service could fall short of expectations. Disney does have a bad pass of pushing content into the market too quickly, like I previously mentioned with Star Wars. So that could fall short of expectations. And another big one is digital content piracy. With access to information nowadays and the internet, anyone pretty much has unlimited access to anything. This includes pirating content from the internet, such as movies and TV shows. And Disney falls within that realm as well. Anytime that someone streams something that is not directly from them, from an outside source, whether illegal or legal streaming website, Disney does lose money from that. And as they continue expansions and produce more and more content, that is surely to happen. Our final slide, our recommendation slide. If I were an investor looking into Disney, I would absolutely invest. Bob Iger has taken Disney from a family-friendly blockbuster producer to a global entertainment powerhouse, the one that we know today. Analysis of financial statements shows little loss, however exceptional performance at generating profit. Take a look at their net income, rising up to 40.3%. Disney has acquired household names over the last few years, such as Marvel, Lucasfilm, Pixar, 21st Century Fox. And as business expands, they will surely acquire more. And Disney's willingness to take risks and go into new markets has showed nothing but success. Think streaming, think sports, #1 box office hits, and expanding into China, which is what every company would wish to do today. They have many strengths, great deal of opportunity, and for what I see, little weakness. And even in unexpected future economic downturns, if that were to ever happen, Disney would be a little affected. They would be able to easily weather through any economic downturn because of their high profits. If I were to recommend this to anyone, I would recommend the Walt Disney Company as a buy.